to the marketplace, and then tells you based on evaluation, is this something that is better or worse than the last case you ran? And then of course, the thing we've all heard about and seen many times is the pitch deck. And that's the deck that you use to present to investors. And is that pitch deck a really great one? Can the entrepreneur present it well? I had a conversation with a client yesterday, and I was talking to him. You need to be able to present your deck without looking at the slides, without looking at your notes, and know exactly what your stories are and how you're going to get from the beginning to the end.
And how do all these pieces come together?
Well, that one's an interesting one because in one of the conversations we just had in our group meeting prior to this, as you look at raising capital, the pitch deck, the financial model, the business plan, and strategy all need to fit together. So that means, for example, if let's say you're going up and pitching and you say, we're looking for a $5 million A round, you need to have your financial forecast model reflect that you need $5 million to get there, where the money is going to be used, and how you're going to execute. So there's a good fit between the deck and your financial model. Business plan, the same thing. They all need to tie together so that the strategy of the business is reflected in the documents and that they tell a cohesive story. And I'm not talking about a fairy tale, which lots of entrepreneurs like to tell. You know, they're guessing what's going to happen and no, this has to be a really clear story that is compelling and exciting to investors. One of the key things that I find a lot of the time is that an entrepreneur's got a widget and they're very excited about the widget and they're explaining all the details and the color and the hinge and all that. Investor doesn't care. The investor cares about getting excited about the business and really determining, are you the best person to run it?
Yeah, good points. I mean, with our pitch force, there's two parts. There's a 1-minute elevator pitch, and then the top 5 companies out of 10 get to do a 4-minute PowerPoint. And we tell the companies, you know, you've got to get people excited about what you're doing. And one of the mistakes that we see entrepreneurs often make is they're pitching, they're looking for money. That all makes sense, but they're not thinking about the catchers. The catchers are the investors. And one of our points, point number 7 is WIIFM, which the investors are thinking, what's in it for me? And to be able to address that, and it can be done in a 4-minute pitch, is really, really important. The point you mentioned about having, you know, knowing your pitch so you're not going up there with notes. For 8 years, we did pitch forces weekly, live and in person, until March when we went online. Now it's changed because it's easier for entrepreneurs to sort of not have everything memorized and be reading it off a script and try to act like they don't, like they're, you know, real pro using a teleprompter. But a lot of times they get busted. And when we had them live and in person, somebody would come up there with notes and I would just walk up and take the notes out of their hand. And, you know, it's like, if you can't pitch for 4 minutes and get me excited, there's something wrong. And you've got to know your stuff. And sometimes people will say, well, English isn't my first language. That's not an excuse, because some of the best pitches I've ever heard are from people speaking, you know, where English is their second language. So being able to excite people and not just talk about the product, you know, talk about the business. So
you made a couple of really good points there. I mean, when I attended my first pitch force a couple of weeks ago for your Series A round, those points were there. There were many people that literally were reading notes and you could see their eyes going across the screen. And that doesn't excite an investor. It just doesn't.
Now, you know, up until a few years ago, people raising an A round, you know, or a seed round might have been just doing a price round. Now we've got convertible notes, we've got KISS notes, we've got SAFE notes. Would you talk about all the differences, the advantages and disadvantages of each, please?
Sure. Do you have 5 days?
About 5 minutes for that one.
But quick summary. Yeah, there's a variety of different vehicles you can use to raise capital. At the angel round, you want to keep it as simple as possible. And that's to keep legal fees down. We have a number of attorneys on the call. They'll tell you the same thing. So you want to do something that keeps fees down and gets the deal done as quickly as possible and is easy for the investor. You said something a few minutes ago, which is critical when you're doing any kind of fundraising. And that's that you need to think about your customers and your investors first, not yourself. And if you don't, you're going to miss it. So one of the ways to think about your investor is, how do you do this simply? Convertible notes have been the predominant vehicle to raise capital in the angel and seed rounds for a while. They're easy. They let you raise pieces of money at a time. You don't have to raise them all at once. They don't price the company unless you do something poorly when you're setting them up. And a good startup attorney will help you avoid that issue. And convertible notes means it's debt that converts to equity as soon as you have your first price round above a minimum value. And the beauty of that is you get the money, the investor gets a good deal, and the investor gets terms that are equal to or typically better than the venture investor that's putting first round money in. So that's great for both sides. Safes and KISS are two forms of equity investment that also look at not pricing the round, because that's what you want to avoid. They're more complex. The terms are a little bit more difficult, but they're being used more in the earlier rounds. When you get into a priced round, which means that you have an investor who has the expertise to look at the company and give it a value that is believed by other investors, that's typically called your lead venture capitalist, that's normally preferred stock. And preferred stock means that there is some preference given to those investors because they're putting in an initial round of money that's relatively significant. So that's where that goes. So those are the key parts. There's also common stock, and some companies get into trouble earlier and they give away or sell common shares. And in most cases, if you do that, that's what's called pricing the company or valuing the company, because they're attributing a certain value to a share. And that's something you want to avoid as a startup company. You really want your first venture capital investment, first venture capital investor to price the round.
I have a question.
Sure.
Don't the convertible notes usually have a conversion cap on it?
Convertible notes can have a conversion cap on them. It's not required. Some investors require it or want it, and that's part of the negotiation for the round. And that, of course, doesn't price the round. It just says that if the value of the company in your first price round is over the cap, then the investors who are in at the convertible round get the cap, so they get a better deal on those shares.
Right, but you have to
And investors really prefer.
There is a number put on the cap. I agree, it's not a priced round, but there is a number that they put on it.
Yes, that is true. The valuation cap on the convertible debt is essentially saying, if you go over this value, whatever that cap is, the investor at that convertible debt round gets that value, not the priced round value. Correct.
And what we're seeing in the angel community is almost all convertible notes. They're less expensive. They're quicker. Investors prefer them. It's just a lot simpler. And as Brett said, you want to see a cap. If it's uncapped, that doesn't help the investor at all. Brett, let's talk about timing. How long should a company figure it will take to do an A round from start to cash in the bank?
So that one's a wonderful question, because there's a rule of thumb in the industry that it takes 90 days to raise a Series A round. And this was coming up so much that I produced a video that's up on my website about a year ago on how long it actually takes to raise a round. But a typical Series A raise from start to finish, in other words, to produce the documents I talked about at the beginning, the pitch deck, business plan, financial model, figure 9 to 12 months. It can take very much longer than that if you don't really have your act together and don't have a compelling case for customers. But 9 to 12 months is a realistic time frame. And in the article I wrote, it literally breaks down where that time is. Now, if you're further down the road and you've already got a pitch deck and you've already got a financial model, you can take those time blocks off if they're well done. But 9 to 12 months is pretty typical.
Okay. How do companies find the right investor? That's not an easy thing to do.
No, it's not. A lot of the times what founders do is they will go to colleagues, provisors people, and friends and family when they want to go out and raise money. And they will say, hey, I'm raising around, do you know anybody? And Joan Verone, for example, picks up and says, oh, I know Bob over at XYZ VC firm, and let me introduce you. And Joan introduces to Bob at XYZ firm, and Bob, of course, is a colleague and friend of Joan's, and he, of course, says, sure, I'll talk to your person. And although that happens a lot, it's frequently the worst way to go about finding an investor. The key that you're looking for in an investor is, do they have domain expertise in the area that you're raising? What that means is, if I've got a SaaS piece of software and I go to Joan's friend Bob, who's in hardware, that's a complete mismatch. Bob doesn't know anything about SaaS software, doesn't care about SaaS software, and is never going to invest. But now I've wasted 2+ hours of his time and probably 4 or more hours of my time. And that means that the length of time that it's going to take me to raise my round is increasing. That is the bane and the biggest problem that startups have. It's not running out of money, it's running out of time. The money comes next, but you've got to bring that round in as fast as possible. So the first thing you need to look for is finding venture capital firms, private equity firms, whomever, that have domain expertise in the area that you're working. That's number one. The second thing is, you need to then find the partner in the firm who's focusing on that domain. Just because the company works on that domain doesn't mean that anybody except one partner works on it. And venture capital firms have politics going on. So if you choose the wrong partner to present to, who doesn't have that domain expertise, he or she might not tell you that it's their colleague next door who focuses on that. So now you've blown that lead. So partner is second. And then making sure that you get a warm introduction. I cannot tell you how many times people send a document, a pitch deck, an executive summary, literally email, and they expect to get money from that firm. That process alone tells the firm, we're not interested. If you don't know enough to get the right firm, the right partner, and a warm introduction, they are not going to typically spend their time working with you, because it tells them you don't have the chops to make this company successful. You didn't do your homework. You're not willing to find the best people to invest in your firm. And that probably means you're not willing to find the best people to be customers, suppliers, advisors, or anything else.
Good. Any questions? If you've got a question and want to put it in the chat, I'll be happy to entertain those.
Well, this is Kathy. Just on that comment, Brett, that you just made, does the same apply to angel investors about the warm introduction, or is it just more to the VCs?
It applies to angels too. Angels are typically less sophisticated investors. That means they need less solidity in your business and who you are. However, they're human beings too, and they're putting their hard-earned money into you. And if they get a warm lead from somebody they know and trust, they are much more likely to look at your company more seriously and to put money in more quickly than if you don't get that warm introduction. You know, there are firms out there that bring together different angel groups. Band of Angels is one, the Keiretsu Forum is one, Max's Pitch Force is one. And those are great for practicing and for potentially being introduced to angels. And if you can get that warm introduction as well, that gives you a big, big leg up.
Other
I got a
questions?
question, Brett.
Go ahead.
Go ahead.
Oh, great. So in the, whether it's pre-seed or seed round, how much, is there a ratio that investors like to see in, a business or entrepreneur put into the business? Is there a ratio of their own personal assets compared to how much they're trying to raise?
Not really. There is thought that they should have some skin in the game, and skin in the game could be financial. So they could have put in 10 or 20 or 30 grand to start it up. It could be 5 years of sweat equity that they've been working on this problem, that it's been really important to them and they've got a solution for it. So that's what it is. But investors care less about how much money the entrepreneur founder puts in. They're more concerned about the compelling case for customers. Is this founder the best founder to take this particular business forward? If you look at it, investors see hundreds of presentations a year, hundreds, sometimes thousands. And they see the same idea presented by multiple groups over that time. Just because you've got a new idea, I can pretty much tell you there's a competitor out there. It's not unique. So what they're looking for is the idea compelling? Is this something that they're interested in? And are you the jockey to ride this horse and take this business forward? And that's what they're looking for. And if you can convince them of that, how much money you put in is really not that big of a deal. Are you working on it full time? Have you been working on it full time? Are you dedicated to this business? That's a big deal.
Yeah, I just piggybacking on that, I agree with all that. And sometimes you will see early stage entrepreneurs looking to raise money and they're not working it full time, and that's a no-no.
Big red flag.
And to the point of entrepreneurs putting their own cash in, for some 27-year-old guy who's worked a year on it and doesn't have a whole lot of money, maybe putting 25,000 in is a lot. But I've seen pitches where guys say, "Oh, I had to exit here. We have 30 million at this exit, that exit. Well, how much of your own cash are you investing?" "Well, I think I'm going to put 25,000 in." Well, and then, we're not buying that. If you're coming off as such a successful entrepreneur with all these exits, you better have some serious cash in. On the other hand, I had conversations with two investors in the last 3 months who have put $20 million of their own money into a business that isn't going anywhere. Now, if you're putting 20 million in and you're worth, $1 billion, it's not much. But one guy he's tapped out. He's a mad scientist kind of guy, and he's living off a second on his house. And it's like, that's, even if you have a lot of money, you put 20 million of your own cash is crazy. If you got a lot of money, you put $500,000 in or $1 million, and you better go find out if what you're doing is really being valued by others in the marketplace. And it's sad when you see that.
Yep. One of the things that came up in our session before this by two different people who were in the group was lack of experience in doing this. And I can't emphasize that enough. Both of these people in our group relate experiences where the company or the founder didn't have enough experience and they blew it, either because there was, during due diligence, some issues with payroll, in one instance, and in another instance, there was issues with the financials not holding up in due diligence. Both of those are very common. There are thousands of things you have to do to start up a business well. And just because something looks important doesn't mean that something else isn't. And if you blow something like that, you run into a minefield. So asking and getting the right expertise in legal, in IP, in all of the different functions is really important. And that takes money. Yeah. Somebody, I think, had a question as I was just starting.
I have a question, Dan Bodner. I'm actually involved in a startup right now. And this is my first go round with this sort of thing. You mentioned going to investors. You shouldn't. You need to go to investors that have the domain expertise, but to go with a warm lead. So it seems a little bit of a contradiction. To get the warm lead, you'll need to do some networking. I guess the point would be to try to focus your networking in that direction, but it's a really hard thing to get a warm lead to someone that you don't know in your domain space, where you may not actually know anybody that knows them. So it's a bit of a conundrum. Did you have any thoughts about that?
It is a conundrum, and this is where your creativity and your resourcefulness will come in and pay off. And again, it's one of the things that investors look for, and they look askance if you didn't do your homework and don't do this well. So yes, it's hard. If it was easy, everybody would be doing startups and everybody would be getting funded. So yeah, it requires domain checking first, using the databases that are available to get the right firm, finding the right partner, and then pulling out every stop you can to get that warm introduction. Anything from, LinkedIn profile checks and seeing if there's a second or third degree separation between you and anybody you know and the person you want to get introduced to. It could be you researching this partner. I mean, let's say there's 4 firms that are really the firms with 4 different partners in each firm. That's when you need to do your homework, Dan, and say, I need to find out everything I can about Max Shapiro. He's my investor of choice. And what are his interests? Well, he's interested in basketball. Wow, basketball. Okay, who do I know that is interested in basketball that may know him? Can I find him at a game and meet him at the game and say hi? What can you do to be really creative to get that warm introduction? That's what investors want to see, that tenacity, that focus that says, look, if this guy can find me, I don't know this guy from a hole in the wall, he is going to be able to do what it takes to make this business successful. It's one of the measures that they use, conscious or not.
Yeah, it's a great answer. And on the point of tenacity, person I know that used to run an angel group was notorious for not getting back to people that emailed her. And I talked to her about it once, and she said, you know what, I want to see, just because somebody emailed me once, I may not get back to them, but if they're emailing me 3-4 times, I know they're tenacious, they're committed. And some people say, well, you shouldn't do that, it's rude. If she doesn't want to get your emails anymore, she'll let you know. That's the beauty of emails versus making calls. We've got time for one more question if we've got it before we allow everybody to introduce themselves. Yeah, Rick, go ahead, please.
So Brett, you mentioned the compelling case for customers, and I was curious, is that part of your work when you see a potential client, and they don't necessarily have that yet, or it's not clearly articulated? Do you work, is that part of your service that you help them develop that and clearly articulate it to investors, or do you kind of send them away and say, and maybe refer them to somebody else and then tell them, come back to me when that's done?
I'll give you a short answer and a long answer. The short answer is yes.
Okay.
The long answer is that 97% of the companies that come to me to raise capital do not have a compelling case for customers. They believe strongly, and they would fall on their sword, that they do have a compelling case for customers. But when they really finally understand what that means, they don't. They've got a widget that looks cool, that weighs something, that does something, but there's nothing compelling about that. So yeah, a big part of my work on the strategy side up front, and this is why I've been doing so much strategy work over the last 9 months with COVID. Series A raises went away for a month when COVID hit. They've come back, but they were silent. But a lot of my work over the last 9 months has been strategy work. What's compelling? How do we make your business more compelling? What can we do to pivot and lean into what's happening with COVID? And, when you ask the question of the senior staff, CEO, CMO, CTO, what's your compelling case for customers? Ask it individually and see what comes back. If they don't all have the exact same answer for what's compelling, I have work to do. So yeah, that's a big part of my work up front, because if we can't get to that compelling case for customers, Rick, I can't do work on the pitch deck, the financial model, the business plan. There's no there. So we have to do that to begin with, and then move into codifying it, understanding the business case that provides the highest valuation, that's going to give the investors the return on investment that they need, so that we can figure out, we need this much in the A round, we need this much in the B round, we have this much time between those 2 rounds, and our step up in valuation, in other words, our increase in value between A and B, is sufficient so that the A round investor sees a clear path to liquidity. All that has to be done up front. And when I look at raising a round, I look at the existing round and 2 rounds in advance, in addition to the value at the end. That's what you have to do, really, to convince investors that you're the right company for them.
Brett, we are out of time. Thank you so much. This has been really fantastic, very educational, delightful. Please put your email address. I spent some time on Brett's website, and the videos, short videos he's got explaining all this stuff are fantastic. highly recommend that if you're working with a company that's looking for funding, that you talk to Brett, because I'm sure he can help. We're